Hi everyone, and welcome to Investing Strategies. It's Alissa Coram with Investors Business Daily from the NASDAQ market site in Times Square. And the holiday shopping season is now officially upon us. That means we're taking stock of the retail and e-commerce trends you should be watching. And we're getting initial insights into this year's Black Friday and Cyber Monday shopping results. Plus, we're taking a detailed look at the chart of one of this year's e-commerce winners. And no, it's not Amazon. We're also discussing an ETF that helps investors gain exposure to companies benefiting from internet-enabled innovation, from e-commerce to cloud computing. Investing Strategies starts now. Let's begin with this week's market insights. All three major indexes hit more record highs during the shortened holiday week. And for the month of November, the NASDAQ added 4.6%, while the S&P 500 gained 3.4%, and the Dow added 3.7%. That makes it the best month for the major indexes since June. We also haven't seen a loss of greater than 1% for any of the major indexes since October 8th. Since a new uptrend began in early October, the run has been characterized by low volatility. That reflects a confident market. But of course, investors are smart to be on guard for a normal pullback after such strong gains. But make sure to wait for the market to actually give you those signals before getting too conservative too quickly, just because some Wall Street pundits say the market's getting overheated as we continue to score new highs. And with that, let's turn our attention to this week's spotlight on retail and e-commerce. The holiday shopping season is now in full force, and here to break down the key trends to watch is Greg Portell. He's the head of Global Consumer Industries and Retail Practice at A.T. Kearney. Thanks so much for joining me today, Greg.
Thank you.
All right, so we have seen record numbers already this year for online shopping. What are your initial takeaways so far this holiday shopping season?
The consumer is incredibly healthy, but I think we already knew that going in. What's really exciting is to see how retailers have really put this integrated commerce strategy together, because we're seeing, mobile shopping increasing. We're seeing the buy online, pick up in store being enacted seamlessly through these retailers. So they've really got this concept of integrated commerce really starting to mature, which is pretty exciting.
And going a little bit behind the curtain of e-commerce, with the record numbers of packages that need to be fulfilled and delivered, that puts a lot of strain too. So how are a lot of these retailers tactically adjusting because of that?
Well, the real challenge for all of these retailers is it's really unknown territory. We haven't had this much volume this fast in the history of e-commerce. So that puts a lot of pressure on the management teams to be able to react and adjust on the fly. But the two things that we're looking for in terms of success is, one, do they have the IT infrastructure to back it up? I think we saw some glitches on Friday that you go down for a few minutes at sales paces that we're looking at, and it hurts. The second big part is, how do you manage your labor exposure? Because all of these stores need to bulk up on their store associates, their sales associates, their inventory specialists. And the key being here that consumers want connectivity and authenticity with those sales associates. These aren't just transactional roles anymore.
Right. So do you think that that's one of the big key differentiators then? I mean, we hear a lot about e-commerce behemoth Amazon taking a lot of share from the online side. So what are the different ways, both online and offline, that these other retailers are trying to compete?
Well, it's interesting, because if you're going to do chore shopping, if you just want convenience, then online's going to win every time. Now, online pickup in store, maybe that's a little bit of a wrinkle, but it'll go definitely to something that is quick and frictionless. What we found when we looked at Gen Z consumers, they actually like the experience in stores. And in order to fulfill that and meet that expectation, retailers need to invest in those sales associates that know what they're talking about, that buy the products they're trying to sell, and can actually explain and help a shopper sort through the various different options.
Right, and then I think in terms of the Black Friday shopping extravaganza, trying to fight all the crowds, that might be one benefit to online shopping. So for this particular past weekend, is there a difference there, or is the experience still something that is valued even when there's heavy crowds?
Well, that's really the paradox, Alissa. So I was talking to a client of mine just over the weekend, And they were trying to find that balance because we know consumers like the experience. There's nothing good about the experience of Black Friday, particularly when it's raining and the weather's bad. So finding that excitement of the celebration, the reason to bring people into stores for special experiences, that's an important part of Black Friday. If you just rely on price discounts,
right,
you're going to push people online, which is an okay strategy because we need to get past this divide between online and physical. It's all about the integrated experience at this point.
Yeah, speaking of the discounts, how do you think that the strategy around that has evolved over the last several years, especially since now it's so easy to compare all of the different prices for the discounts?
Well, what's interesting from an investor standpoint, it makes it really challenging because sales at low margins aren't necessarily healthy sales. So what we're encouraging clients to do is really use that merchant muscle. So if I'm looking at a company and I'm trying to find out if they're going to be successful this holiday season or not, I really want to understand how have they invested in merchant capabilities? Because yes, they're going to sell that one product at 70% off, but what else can they get in your shopping basket at a higher margin? And that's the magic of the merchandiser. And that's a critical success factor on who will win and who will lose from a profit perspective after the holiday season.
Do these retailers use a Black Friday and Cyber Monday as an opportunity to take market share away from other competitors beyond just the holidays, or how do they approach that?
I don't think we've gotten to the point where retailers really use these commercial holidays for loyalty. I mean, they're really doing two things. They're generating buzz and they're trying to get a spike and get some attention during the holiday season, which is always important. And then the other piece is they're really trying to activate their loyalty programs. You figure retailers have spent hundreds of millions of dollars at this point on relationship management softwares. They need to get a return on that, and that all comes back to knowing your consumer. If they take that consumer-centric lens, they'll find a lot more success.
And speaking of customer loyalty, what has your latest research shown you about where consumers are shopping when you talk about the overlay of some of the hot political topics or socially responsible topics that we're hearing about?
What we're finding is consumers really value an authentic reply. So if you think about the speed with which companies are working nowadays, they have to work with much more agility, much closer to the edge. That brings on more risk. So companies are going to make mistakes, particularly when they rely on frontline employees that are somewhat transient in employment. So that's always going to be there as a risk for retailers and consumer products companies. The expectation from consumers is not that you're perfect, but when you make a mistake and you identify that mistake, that you own it and you fix it. It's not, a press release won't get you by anymore. You have to make systemic change when there's a real problem, and consumers will move on.
Interesting. Well, it sounds like the key to the holiday shopping season is cracking the code of both online and offline.
It's understanding that it's just commerce. It's integrated commerce. Consumers don't shop by channel. They shop by product, they shop by present, they shop by recipient. That's how you really define success, is when you're looking at it on the consumer's terms. And that'll really make the big difference.
Interesting. All right. Well, thank you so much for the enlightening conversation.
Thank you.
All right. And coming up after the break, I'm taking a look at the chart of an e-commerce winner and another big name that's been lagging in the group. We'll be right back.
Are we ready to do this?
Okay, here we go.
Good morning, everyone, and welcome to IBD Live. IBD Live is for just about any investor.
IBD Live is a look behind the curtain.
It's kind of bringing our subscribers into that whole conversation that we're having on a daily basis.
You're just going to be fully immersed in the rules of growth stock investing.
I think IBD Live, honestly, is probably one of the best values out there because you get to leverage off of others' experience.
You're going to speed up your learning curve dramatically.
If you really want to know what's happening right now, what can you do today, IBD Live is where you should be.
If you capture one or two of these stocks, it's going to pay for the subscription itself.
Learning in the stock market is a lifelong adventure, and I think IBD Live helps make it an exciting and hopefully a profitable one.
Holiday shoppers are making purchases online in increasing numbers, with Black Friday e-commerce sales hitting $7.4 billion this year, an all-time record for that day. And while Amazon is an e-commerce behemoth, other top retailers are upping their game to compete with Jeff Bezos, and it extends beyond just Black Friday. Target is a great example of a company that's investing in its e-commerce strategy and benefiting. Target saw online customer spending increase a whopping 47% during the first 2 weeks of November from last year, while Amazon's customer spending grew 32% during that same time frame. That's according to Ecommerce Trends. Now, this is a weekly chart of Target here, and it's seen strong gains this year. It's almost doubled, and the last couple of months have been notably strong, providing investors several buying opportunities. Now, Target broke out of a long consolidation on its late August quarterly earnings report, which showed earnings growth of 24%. That marked a second quarter of acceleration. The retailer also gapped up on its latest quarterly report on November 11th, when we saw more acceleration in earnings to 25% for the quarter. Target also saw comparable sales for its digital channel grow 31% in Q3, on top of 49% growth last year. Same-day fulfillment services accounted for some 80% of Target's digital comparable sales growth. Now, both of these breakaway gaps on earnings are opportunities for investors to buy shares. Now, it might seem a little counterintuitive when you see a stock surging big like that, but IBD's research actually shows that these moves are often the precursor to even further gains. And the proof of that is right here. Now let's take a look at this current action a little closer on a daily chart. And what we'd like to see from here after this latest gap up that sent shares some 14% higher in one day would be for Target to hold these gains. And so far, the stock is holding gains and trading in a relatively tight range. And for investors who miss these breakaway gaps, wait for another proper entry to form. And swing traders could look for the stock to clear a short consolidation as a chance to get in. Now let's quickly contrast Target's chart with that of Amazon here. Now the e-commerce giant hasn't really gone anywhere the last few months. Shares are currently consolidating and are hitting some resistance at the 40-week moving average. That's this gray line here. While Amazon has been a huge long-term winner, this just goes to show you that you shouldn't let that alone be the determining factor for buying or holding a stock, because you could be missing out on other stocks like Target that are rocketing higher on a big fundamental story. Okay, so when we come back, we're taking a look at an ETF that's all about capturing gains from companies benefiting from the internet-enabled innovation trend. We'll be right back.
This season on Cultural Capital, we are in New York City and San Francisco. Come with me as I tour some of the world's most innovative companies, from Squarespace to C3AI, Giphy, and Figma. Learn how CEOs built growing companies while maintaining the ultimate office culture on Season 3 of Cultural Capital on the brand new NASDAQ.com.
Welcome back, everyone. And joining us now to discuss one way investors can gain exposure to companies benefiting from internet-enabled innovation is James Wang with ARK Invest. He's an analyst on their next generation internet team. Thanks so much for being here today, James.
Thank you, Alissa.
All right, so when we're talking about this next generation internet trend, there's a lot of different industries that fall under this category.
Yes. The way to think about it, our strategy, we have top 4 level themes in this strategy. We focus on e-commerce, we focus on cloud, fintech increasingly, and artificial intelligence. These are kind of 4 broad buckets that most of our companies fall under. And each of these are multi-$100 billion industries and at different levels of maturity. In this strategy, we're basically trying to help investors discover what is the next wave of the internet. Lots of people talk about kind of today and FANG. A lot of that is in the past. So being active managers, we're trying to trace the path forward for the future.
And with it being in the middle of the holiday shopping season, I think a lot of people are focused on e-commerce in particular. So what are you seeing in that space that is really shifting?
E-commerce is such an enduring theme, right? It was one of the first technologies and business models that actually worked for the internet. Amazon's probably the only company of that era that is still mega successful today. So we remain to have Amazon in the portfolio, but when we look at it, the strategies and the way the companies are acquiring customers and the way they monetize is much more different today than it was. And one area that's so obvious is China. They have e-commerce penetration as a share of retail that's twice as high as the US. They have by far the most advanced e-commerce penetration globally. And a company there that is just completely rewiring the way people buy online is called Pinduoduo. PDD is the ticker. And that's one of our top positions in ARKW. Just to give you context, Pinduoduo is doubling its revenues every year. Last quarter, it reported more than 100% revenue growth at a $3.6 billion revenue base. That's simply unheard of. You can have fast growth or high revenues, but very rarely do you have both. Amazon, when they were at about $3.6 billion in revenues, was growing at 30%. So it's growing 4 times the scale of revenue, just given the conditions of China and where we are in the internet cycle.
And the fact that PDD has a bigger weighting in this ETF than the likes of Amazon and even Alibaba, what do you think that says about the strategy that you guys are taking with this ETF?
So most ETFs are passive products. ARKW is a fully actively managed ETF, so it is managed like a mutual fund or a hedge fund, but it's traded like an exchange fund, so it's very transparent and easy to own, if you will. So we can take very strongly opinionated bets, not just based on market cap or smart beta indices, but based on fundamental research we do. And PDD, we've just discovered that their selling model is completely disruptive relative to everyone else. For example, people compare it to Groupon, as in it's a group buying site, right? A lot of people come together to buy something at a discount. But with Groupon, the company had to set up the deals. The company had to call up Starbucks or Joe's Coffee and say, hey, would you put together a deal? So it was a very slow model, and it never succeeded. It's one of the most famous internet flops, in fact, in US kind of internet space. But PDD, the deals are done organically among users. So it's literally Joe and Lisa and a bunch of people getting together and say, hey, would you like to buy a bunch of watermelons or peaches or toilet paper together? And it just forms organic deals, almost like a social network online, and people start buying. It sounds a bit crazy for us. It doesn't sound like anything we would do. But China had, the consumers there just have such different social norms. They're so much more open to new ways of doing things that you can build entirely new e-commerce models in China. So it's just a much more exciting market.
Yeah, well, it sounds like a very interesting fundamental story to watch. And another area that's in the ETF is payments. So, I mean, how is that area evolving? PayPal seems to be one that's thought of as an incumbent, but what's the shakeup happening there?
So the shakeup is PayPal, was one of the original companies that, along with kind of Amazon in that era, Peter Thiel, Elon Musk started that company, and it did great in the web era of the internet, the PC era of the internet. But once things went mobile, they just didn't really wake up and fully embrace mobile. And so new competitors have emerged. Venmo is probably the most successful in the West that we know about. I'm sure we all use it to pay, split dinners and things like that. So they acquired Venmo, and that has given them kind of a new leg up in this kind of new way of doing payments, mobile payments. But what we found is that actually, while it's had great success, a great growth story, this growth has slowed down dramatically. When we look at, we've looked into some very specific data, they've slowed down specifically. And Square is in fact growing much faster than Venmo is right now. Square is especially growing in the interior of the US, whereas Venmo is kind of more known in kind of coastal areas. But our expectation is that over time, Square has a real chance of overtaking Venmo and really capturing more of the peer-to-peer payments. And the way people use Square Cash is also very different. They use it more like a bank. They use it for kind of payday advances and banking services. And there's just a huge difference in the value of what a Square customer is worth and what a banking customer is worth. Like a typical bank or Chase will spend on the order of $1,000 or $2,000 to acquire a customer. With Square Cash, it's purely digital. You just download it through the App Store. Maybe your friends will send you a referral code. The cost of acquisition is on the order of like $20. So you have these 3 orders of magnitude just in customer acquisition cost, which is extremely disruptive to the banking model. 0809 has been extremely disruptive for finance as a very, very large scale, at the scale of financial institutions. But we haven't really had products that really disrupt and change the way people use these things. People are not really paying attention to this. People think it's kind of a toy. It's kind of a low-end problem being solved, just splitting a dinner and things like that. but these people are going to end up as customers for life for these platforms. And these companies eventually will be treated like banks.
Interesting. Yeah, I agree. I don't think enough is being paid attention to that. I definitely learned something new there. And then also tell us about Tesla being a major holding in this ETF. Of course, in the headlines, I feel like always, but especially a late resurgence in that with their Cybertruck. Why is Tesla such a big part of the next generation internet story?
Exactly, right? It's an internet fund. Why does it own an automaker? It's because Tesla doesn't view itself as an automaker, and its business, where its business is going, is not just about building and selling cars, right? Yes, today most of it is about manufacturing. But if you look at what its actual competitive advantages are vis-a-vis the incumbent, it was the first to switch to EVs in a big way. It basically forced the whole world, the whole EV industry, to scramble to EVs. Very similar to what Apple did when they launched the iPhone. But more importantly, they have a very particular vision about how they're going to execute to become a car company that provides autonomous transport, which will eventually basically be a taxi fleet. We can debate the timelines on that, but essentially its key advantage there is that it is executing artificial intelligence at scale using a data-driven approach. When you talk about people who are following this industry closely, they say, oh wow, the whole hype about autonomous driving has been pushed out because it's way more difficult. Everyone is stumbling. That is true. Everyone is stumbling, but everyone is using basically the same approach of a small amount of data or a moderate amount of data collected using a fleet of maybe 100 test vehicles and then trying to generate an AI algorithm that can drive itself. The data is just not sufficient for the complexity of the problem. Tesla's approach is completely different than everyone else's. So when you say the approach is failing, it applies broadly to everyone, but it doesn't apply to Tesla. Tesla may still run into its own issues, but at least those objections do not fall on Tesla. Basically, they have a fleet that is growing by the day, that is sending data on how people drive, and its AI algorithms can learn from how people actually drive and imitate that process. And no one else is doing it using this approach. So they have this unique potential to succeed based on this, and if they do, their whole margin structure, their revenue stream will be driven around a services model, and it will be the biggest business model shift since maybe Amazon to AWS.
Right. I think the vision aspect is very compelling, but when you look about the price performance, it's definitely been more choppy. So when do you think that Tesla can get past some of these hurdles and issues that you're talking about and really be a big winner price-wise?
Right. So Tesla's unit shipments have basically not grown in the last quarter, and they're really just waiting for the Gigafactory in China to open up. They've committed to building one also in Germany. So really it's about ramping production. Right now, most of the valuation around Tesla short term by the market is around how many units of cars they can sell. Once China basically ramps up, I think we'll get some appreciation from the market around that. I think the Cybertruck pickup orders people are not taking seriously at all. They have 250,000 reservations right now. If 50% of that converts, that's going to be on the order of $6 billion in revenue. People don't seem to believe, even with those reservations, that it's going to happen. Granted, it's a $100 reservation, but the people people said the same thing with the Model 3. It was $1,000, and people are like, it's not clear if people will buy it in the end. The chatter, what I've heard, and I've even just heard friends' moms put down reservations for this thing. It has. Wow. I think people are expecting this thing to be a complete dud, and it is completely throwing mud in their face. I think once you start seeing actual shipments, the narrative is going to change in a big way.
All right, well, Tesla, a big component of this ETF, and when we take a step back, performance-wise, ARKW has been doing pretty good for investors lately. So do you feel like we're still in the early innings of where this whole trend could be going?
Yeah, ARKW is up about 28% this year versus 25% for the S&P. The internet as a technology is not one thing anymore. It's multiple sub-themes like fintech and AI, and it's each at different levels of maturity. I find it very exciting to follow this theme because something new is always about to happen, and our whole thesis is trying to capture that when it's at kind of a 10%-ish inflection point. So, for example, for artificial intelligence, the press, everyone's beaten it to death, and it seems like an old idea, but it hasn't even started. I mean, most companies haven't even started using it. We are barely starting to use it. So it's extremely early, and that's going to be an easily multi-trillion-dollar opportunity once all said is done. Yeah, I'm very excited to follow it through. I think like investing in themes like that is as durable as investing in e-commerce or cloud maybe 5 years ago. And it's one of those themes you can really hold on and grow rather than try to find new ideas every 6 months.
Well, thank you so much for such a wide-ranging discussion today. It's definitely a very interesting space to watch. Thank you.
Thank you, Alissa.
And thanks everyone for watching Investing Strategies. Next week on the show, it's our final episode of Season 1, and we'll be giving you insights into investing trends to watch and portfolio strategies to consider as we wrap up 2019 and head into 2020. Until next time, I'm Alissa Coram.